Okay, so we've been told for decades that the dollar's dominance is basically permanent, right? But when you actually trace the data back 15 years and then project it forward, the trend line doesn't just bend, it breaks. And that breaking point, it looks like it might be happening right now. But before we dig in, I want to be clear that this is an educational and analytical discussion of geopolitical and macroeconomic shifts. The analysis is based on publicly available data, official reporting, and my own assessment of how incentives and structures interact. I am not promoting any ideology. This is about understanding the forces shaping the system. Here's what caught my attention initially. Back in December, Bloomberg ran a piece with a headline that, honestly, I would have dismissed as clickbait 5 years ago. The dollar's exorbitant privilege is on borrowed time, and Bloomberg isn't exactly known for hyperbole. They're mainstream financial journalism, the kind that usually reassures institutional investors. So I pulled the actual numbers from the IMF's Currency Composition of Official Foreign Exchange Reserves database, COFR, if you're into acronyms. What I found validated Bloomberg's framing more than I expected. As of the third quarter of 2025, the US dollar's share of allocated foreign exchange reserves held by central banks worldwide had dropped below 57%. That might not sound dramatic until you realize it was over 65% just a decade earlier. That's an 8 percentage point decline in 10 years, and the pace is accelerating, not slowing. But here's where my analysis diverges from the standard reporting. Most articles I read stopped at that headline number. They didn't ask the next logical question: what are central banks buying instead? And more importantly, why are they doing it now when they've tolerated dollar dominance for 70 years? I spent a week cross-referencing central bank reports, sovereign wealth fund disclosures, and trade settlement data. What emerged wasn't just a story about diversification for diversification's sake. It was a story about rational actors responding to a shifting risk-reward calculation that's fundamentally changed in the last 3 years. The Financial Times published an investigation in mid-2025 that confirmed something I'd been suspecting based on trade patterns. They asked, do central banks really have more gold than US Treasury bonds? Their conclusion, after adjusting for valuation differences, was essentially yes. The two asset classes had reached parity by June 2025. But here's my own calculation they didn't fully incorporate. Gold prices rose another $1,000 per ounce in the 6 months after their analysis. So by the start of 2026, gold had definitively overtaken US Treasuries as the primary reserve asset held by foreign central banks. That's not just a statistical quirk. That's a 30-year trend reversing itself. Let me put this in perspective because this is the kind of historical context that gets glossed over. For roughly 3 decades, since the mid-1990s, we've lived under what economists call the Treasury standard. U.S. government debt wasn't just a safe asset, it was the reserve asset. Central banks held it not just for liquidity, but because it conferred a kind of geopolitical insurance. Holding treasuries meant alignment with the U.S.-led order. It meant access to dollar swap lines in a crisis. It meant essentially membership in the club. That system rested on what the French politician Valéry Giscard d'Estaing famously called America's exorbitant privilege. The ability to borrow in your own currency, run persistent deficits, and have the rest of the world finance it because they need your currency for trade and reserves. But privileges, when they're abused, tend to get revoked. And from my perspective, we've crossed that threshold. Let me pause here for a moment because I know this gets dense, and when I'm deep in research like this, I tend to forget basic things like eating lunch. That's where Mom's Meals has genuinely fit into my routine. They deliver chef-prepared, ready-to-eat meals that I can just heat up between reading central bank reports. What's worked for me is the variety. They have keto-friendly meals, diabetic-friendly options, low-carb, low-cholesterol, halal, vegetarian meals, and honestly, a lot more categories I haven't even tried yet. The convenience factor is huge when you're juggling analysis with deadlines. Prices start from just $7.99 per meal, which is less than I was spending on takeout anyway. If you want to try it, I've put the link in the description. You can get 50% off your first order. It's been helpful for me, might be worth checking out if you're in a similar situation. Now, back to the central question that's been bugging me. Why is this acceleration happening now? The dollar's dominance has been questioned before, but it's always proven resilient. What's different this time? I think the answer lies in what I'd call a credible threat escalation loop that's fundamentally altered the risk calculation for any country not firmly in the U.S. orbit. Let me walk through my reasoning here, because this is where standard analysis tends to miss the forest for the trees. The traditional view is that countries hold dollars because there's no viable alternative. The euro has its own structural issues. The yen's market is too closed. The pound is too small. China's capital controls make the renminbi impractical for full reserve status. All true as far as it goes. But this analysis treats reserve diversification as a binary choice. Either you stick with the dollar or you jump to a single replacement. That's not what's happening. What I'm seeing is a more sophisticated distributed hedging strategy. Central banks aren't replacing dollars with one alternative. They're building a portfolio of non-dollar options that collectively reduce their vulnerability. Gold is the anchor because it's politically neutral. No government can freeze it or devalue it through printing. But there's also a rapid expansion of bilateral currency agreements, regional payment systems, and commodity-backed trade arrangements that bypass the dollar entirely. The 2008 financial crisis was the first wake-up call. I went back and looked at central bank gold purchases over time, and the shift is stark. Before 2008, central banks were net sellers of gold, about 500 tons per year on average. After 2008, they became net buyers, and that buying accelerated after 2022. The trend line isn't smooth. It has two clear inflection points. Here's what I find fascinating about the timing. 2008 taught central banks that the US financial system itself, Wall Street, the shadow banking sector, the derivatives complex, was a source of systemic risk. But it wasn't enough to trigger a mass exodus because the dollar's role as a safe haven paradoxically strengthened during the crisis. Everyone rushed into treasuries. The Ukraine conflict and the subsequent sanctions changed that dynamic completely. When the US and Europe froze roughly $300 billion in Russian central bank assets, they didn't just punish Russia. They demonstrated that any country's reserves could be weaponized if geopolitical winds shifted. And here's my assessment. The message wasn't lost on the 100-plus countries in the global south watching this unfold. Think about it from their perspective. If you're Brazil, India, South Africa, Saudi Arabia, any mid-sized economy with regional ambitions, you have to ask yourself, could we be next? Not necessarily for military action, but for any policy disagreement that Washington decides is unacceptable. Maybe you want to buy oil from Iran. Maybe you're considering Huawei for your 5G infrastructure. Maybe you just voted the wrong way at the UN. The risk is no longer theoretical. This creates what I'd call a precautionary de-dollarization motive that's far more powerful than any short-term economic calculation. Even if dollar assets still offer slightly better yields or liquidity, the tail risk, the small probability of a catastrophic loss through sanctions, has grown large enough to justify expensive hedging. And here's where my analysis gets into territory I haven't seen fully explored. The sanctions regime has become so broad that it now covers, according to the most comprehensive tracking I've found, roughly 1/3 of all countries on Earth. That includes 60% of low-income nations. When you're sanctioning that many countries, you're not just targeting adversaries, you're creating a coalition of the excluded who have no choice but to build alternative systems. This is where the BRICS initiatives, M-Bridge, the alternative to SWIFT, the contingent reserve arrangement, become rational responses, not just political statements. They're not trying to overthrow the dollar system overnight. They're creating a parallel infrastructure that reduces their dependency and gives them leverage in future negotiations. It's the geopolitical equivalent of diversifying your investment portfolio. Now, let me address the counter-argument I keep hearing from sophisticated financial analysts I respect. They say, yes, but the dollar's network effects are too powerful. The depth of US capital markets, the rule of law, the institutional infrastructure, no other system can replicate that in the near term. They're not wrong about the facts. US Treasury markets are still the deepest and most liquid in the world. New York's legal and financial infrastructure is unmatched. But here's where I think their analysis misses the psychological and political dimension. Network effects work both ways. The more the US uses that network as a weapon, the more incentive others have to build alternatives, even if those alternatives are less efficient in purely economic terms. We're watching a classic security dilemma play out in financial markets. The US sees its financial leverage as a defensive tool to maintain order. Other countries see it as an offensive weapon that threatens their sovereignty. Both perspectives are rational from their vantage points. The result is an arms race, not of weapons, but of financial infrastructure. And here's a point I want to stress that I haven't seen emphasized enough. The private sector is starting to follow the central banks. For years, this was a government-led story. Central banks diversified, but private investors, hedge funds, pension funds, corporations, kept piling into dollar assets. That started cracking in 2025. The Financial Times article I mentioned earlier, "So Long American Exceptionalism," captured this shift perfectly. They quoted a Canadian pension executive saying, "Risk in the US is higher than it was." This is someone managing billions in retirement savings, not a political ideologue. When risk managers at major institutions start pricing in sanctions risk as a separate factor, the cost of capital for US assets rises, even if it's not immediately visible in headline yields. What really struck me in my analysis was the currency hedging data. European investors who bought US stocks in 2025 saw the S&P 500 rise around 16% in dollar terms. But after hedging currency exposure, because the dollar fell against the euro, their actual return was about 2.6%. After inflation, that's a loss of purchasing power. For the first time in my career tracking these flows, US equities underperformed for foreign investors because of currency risk, not in spite of it. That changes the entire calculus. The exorbitant privilege wasn't just about cheap borrowing for the US government. It was about the US being the default destination for global capital, which kept asset prices high and borrowing costs low across the entire economy, from mortgages to corporate bonds. If that capital flow slows or reverses, every interest rate in America creeps higher. Now, let me address the elephant in the room, gold. Because if you're following this story, you've probably seen the predictions that we're heading back to a gold standard. I want to be very clear about my assessment here. That's not happening. And frankly, I find that analysis lazy. Yes, central banks are accumulating gold at a pace we haven't seen in 50 years. Yes, gold has overtaken treasuries as the top reserve asset. But interpreting that as a prelude to a new gold standard misses the entire strategic logic. The gold standard worked when it worked, because it was a rules-based system that constrained monetary policy across all participating countries. It was a discipline mechanism. What central banks are doing now is the opposite. They're holding gold precisely because it gives them more flexibility, not less. Gold is a neutral asset that no single country controls. When you hold gold, you're not beholden to the Federal Reserve's interest rate decisions, or the Treasury's debt ceiling debates, or some future administration's sanctions policy. You can still run whatever monetary policy your domestic economy needs because your currency isn't pegged to gold. The gold just sits there as a hedge, a store of value that exists outside the political system. This is why I call it a shadow reserve renaissance, rather than a return to the gold standard. The last time gold was the dominant reserve asset, before the 1990s, most currencies were still floating against each other. The gold was used for intercentral bank settlements, not to fix exchange rates. We're returning to that model, not to the pre-1971 Bretton Woods system. And here's a nuance that mainstream reports have missed: the distinction between officially declared gold holdings and actual physical accumulation. Bloomberg's investigation revealed something fascinating. Since 2022, the majority of central bank gold purchases haven't been officially reported. They're being held in accounts that don't show up in the standard IMF data. China is the most obvious example. The People's Bank of China reports its gold purchases monthly, but if you compare those numbers to Swiss and UK gold export data, there's a massive discrepancy. Way more gold is flowing into China than the PBOC admits to buying. Some of that is private demand, sure. But the scale suggests, and Bloomberg and the Financial Times both reached this conclusion, that the PBOC is accumulating significant undeclared reserves. Why would they do that? From my strategic perspective, it's brilliant. By not declaring it, China avoids triggering alarm in Washington, avoids accusations of de-dollarization that might provoke further sanctions, and maintains flexibility. They can always officially recognize those holdings later if needed. It's monetary statecraft at a level we haven't seen since the Cold War. So if my analysis is correct, and I should emphasize there's always uncertainty in macroeconomic forecasting, what are the second and third order effects we should expect? First, US fiscal policy is about to get much more constrained. For 2 decades, the US has run large deficits knowing that foreign central banks would absorb the Treasury issuance. That dynamic is ending. The Congressional Budget Office projects trillion-dollar deficits as far as the eye can see, but the buyer base is shrinking. The Federal Reserve will face enormous pressure to monetize more of that debt, which creates inflation risk and could accelerate the very de-dollarization it's trying to prevent. It's a doom loop scenario, and I'm not sure policymakers have fully grasped it yet. Second, the geopolitical implications are profound. A world where trade is settled in multiple currencies and gold is one where U.S. coercive power diminishes dramatically. Not overnight, but steadily. The ability to cut countries off from the dollar system has been America's most effective non-military foreign policy tool. As alternatives mature, that tool dulls. This doesn't mean the U.S. becomes powerless, but it means we shift toward a more conventional great power competition, where military and economic strength matter more than financial system control. Third, and this is where I think most analysis falls short, this creates opportunities for middle powers to assert more autonomy. Look at Uruguay's recent moves. Their central bank is actively de-dollarizing the domestic economy, imposing higher capital requirements on dollar loans, requiring peso pricing, limiting dollar deposits. This isn't a major economy throwing its weight around. It's a small country choosing sovereignty over convenience. Compare that to Argentina under President Milei, who wants to dollarize completely. Abolish the central bank, adopt the US dollar as the national currency. From my perspective, that's not economic policy. That's a decision to voluntarily become a U.S. vassal state. And the kind of people Milei's put in charge, former J.P. Morgan executives running the economy, tells you everything about whose interests that serves. Uruguay and Argentina offer a natural experiment in real time, and I think the results will shape Latin American policy for a generation. The broader point is that de-dollarization is becoming a political choice, not just an economic necessity. Countries are asking, do we want to maintain our monetary sovereignty? The ones that say yes are building the infrastructure to do so, even if it's costly in the short term. For private investors, the implications are just as significant. The era of American exceptionalism in finance, this idea that U.S. assets are the only game in town, is over. The Financial Times piece I mentioned captured this perfectly. In 20 years of market reporting, their journalist had never heard investors talk about U.S. risk. Now it's routine. This isn't just about sanctions risk. It's about currency exposure, valuation risk, political risk, and the reality that U.S. markets may no longer be the automatic outperformers. For a generation of portfolio managers trained to allocate 60% to U.S. assets as a baseline assumption, this requires a complete rethink. So where does this go from here? I'm tracking 3 specific indicators that will tell us whether this is a gradual, manageable shift or something more disruptive. First, I'm watching central bank gold purchases in the first half of 2026. If the pace accelerates beyond the 500 tons per quarter we saw in late 2025, that signals institutional panic, not just prudent diversification. Central banks are usually price-sensitive buyers. If they become price-insensitive, buying regardless of whether gold is at $4,000 or $5,000 per ounce, that tells you the political risk calculus has fundamentally changed. Second, I'm monitoring the uptake of China's cross-border interbank payment system, CIPS. The data is opaque, but my sources in trade finance tell me usage is growing faster than the official numbers suggest. If more than 60% of China's trade is settling through CIPS by mid-2026, which is the trajectory we're on, that's a major milestone. It doesn't replace SWIFT, but it creates a parallel system that could survive even if a country were cut off from SWIFT. Third, and this is more qualitative, I'm watching how the IMF and World Bank respond to these shifts. Their entire governance structure is built around dollar dominance. If we start seeing serious proposals to expand special drawing rights, SDRs, or create new reserve assets that aren't dollar-linked, that would indicate the establishment is trying to manage the transition rather than resist it. My personal take, having looked at this from every angle I can think of, is that we're experiencing a regime change in slow motion. The dollar won't collapse tomorrow. It won't be replaced by a single currency, but its role will diminish from being the indispensable dominant global currency to being an important regional currency. Still significant, but one among several. The U.S. still has enormous advantages: deep capital markets, rule of law, institutional stability, but those advantages are being offset by the risk that those same institutions will be weaponized against you if you cross Washington. That's a risk-benefit calculation that every central bank governor and treasury minister in the world is making right now. And increasingly, the answer is coming back. We need an alternative. Whether this becomes a turning point or a temporary signal depends on policy responses. If the US recognizes this dynamic and pulls back on the aggressive use of sanctions, maybe the trend stabilizes. But based on what I'm seeing from the current administration, threatening BRICS countries with 145% tariffs, doubling down on financial coercion, that seems unlikely. More likely, the US will accelerate the very trend it's trying to prevent. So that's my analysis based on the data I've been tracking. If you found this useful for understanding what's actually driving these shifts, not the headlines, but the incentives and structural forces, then subscribe, share this, hit the notification bell. This kind of macro analysis takes time to put together, and I'll keep doing it if it's helpful. Thanks for watching, and I'll see you in the next one.